All right, why don't we go ahead and get started? So a couple things before we dive into this. If you would like to follow us on Instagram, that would be great. Morningstar Investor AU, or you can listen to our podcast, Investing Compass. And then finally, last little pitch before we get into this thing. Our conference is coming up. So February 3rd, here in Sydney, I put a selection of speakers on here. So you can either come to the conference live, or you can, of course, watch online. So if anyone is interested in the conference, wants a discount on a ticket, just email me. You can also email me the questions. It's mark.lamonica1@morningstar.com. All right, so welcome. Happy New Year, everyone. Hope everyone had a nice break. If you've been on these things before, welcome back. If you're new, then welcome to our webinar. So before we go into this, I need to do a couple of housekeeping items. So number one, anything you hear today is general advice. I don't know anything about you, so I cannot offer personal advice. I would like questions, however. So if you have any questions, send them through. You send them through on the chat, the Q&A. I'll get to them as they come up if they're relevant, or hold off until the end. So feel free to send those through. All right. So let's get started. We're doing things a little bit differently this year. So today we're going to talk about goals-based portfolio construction. But what we've done on the Tuesday webinars is we've arranged for a 8-week, so one a week, obviously, 8-week lesson plan that at least I think teaches you everything that you need to know about investing. And what we've also done is we have formalized this a little bit. So if you register for a session, even if you're unable to attend, or if you attend and want to see it again, we are going to send a follow-up email later today. It will have a link that goes to the replay. So the video will be posted on YouTube, so you can watch a replay if you want, and we'll send through the materials as well. So if you want to review the materials, you certainly can. There's a couple of links in that email that also point to relevant things on our website. So we'll send that through today. And as always, if you have questions, just feel free to email me directly. All right, so this is our lesson plan of the next 8 weeks on Tuesday. So we'll start where we start all of these things, with you and goals. So let's get into it. This is the agenda for today. A lot of what we're going to talk about is contained in our Morningstar Guide to Portfolio Construction, which we'll include a link to in the email that we send out. All right, start in the beginning. Why do we define goals? And many people, I think, when they approach investing, they think the goal is simply to have as much money as possible. And maybe that is the case. And maybe you're sitting there thinking, I am crazy if a goal is, if anyone has a goal that's any different. But that isn't a great approach to take when you're investing, because it generally leads to bad decisions. It generally leads you to do things like buy at the top of the market when you start to get greedy, and of course, sell the bottom of the market when you start to get fearful and you feel like you need to maintain your portfolio's value. So we're going to talk a little bit about why you define goals and why I think that that's the right approach for you to take. All right, so setting a goal allows you to focus on risk capacity instead of risk tolerance. And it also acknowledges the fact that we are all investing for a reason. We're not doing this for our health. We are trying to accomplish something. What you're trying to accomplish is unique to you. It could be retirement. It could be saving for a home. It could be saving for a trip. It could be anything. But the point is that we are trying to accomplish something. And that is how we judge being a successful investor. We don't judge being a successful investor whether you get more returns than your neighbor or your brother or anyone else. It's just meeting your goal. That should be success. So let's talk about these two different terms that we use in here: risk capacity and risk tolerance. So what we at Morningstar think you should focus on is risk capacity. And that is the amount of risk that you need to take in order to achieve a goal. Now, risk, when we're talking about risk in investing, the way the investment industry normally defines it is volatility. So that's how much your portfolio bounces around. on a year-to-year basis or a day-to-day basis. So that's how we're defining risk. Now, at Morningstar, we don't really think that that is the approach that you should take for risk. We think the risk is not achieving your goal, but just know that when the investment industry talks about risk, that is what they are talking about. And most of the time in the industry, most investors focus on risk tolerance. So we'll spend a second talking about what risk tolerance is, and we do cover risk tolerance a lot in next Tuesday's webinar as well. But basically, risk tolerance is supposed to be how much risk you can take at the end of the day. So how much you are comfortable taking. How comfortable are you having your portfolio bounce around? And it's not a great approach to talking about risk and thinking about risk. And it's not a great approach for a number of different reasons, but a couple of them are, as we put in here. Number one, your sense of risk, your risk tolerance changes. Most investors' risk tolerance changes as market conditions change, and it changes in the wrong way, not the way we want it to change. So what that means is that generally as markets go up and returns are really, really strong, all of a sudden we all decide that the market is less risky and we want to put more money in. Now, in reality, that's not true, right? So in reality, if we have year after year after year of above average returns, the market is more likely to go down than up, right? How do we get back to average? We have to have below average returns. So that's the environment we're in right now. Had a lot of years of above average returns. You go back and look at 5 and 10-year periods, they're all above historical average. Now, many people use that as an opportunity, as I said, to put more money into risk assets, and it's not really a great approach. Same thing happens when the market goes down. So as the market falls and falls and falls, people get very nervous, as they should. It's human nature. But what that means is your risk tolerance changes again. And all of a sudden, you are very risk adverse and you want to take money out of risk assets like shares and put them into cash. Once again, that's the wrong time to do that. So assessing a risk tolerance is not a point in time, or is not a one-time only thing. It's more of a point in time thing. And that's not the way that the industry generally does it. They'll generally give you a risk tolerance questionnaire when you sign up for a product or with a financial advisor, and then don't test it anymore and your risk tolerance will change over time. The other thing, of course, is humans have a really difficult time of assessing how they'll act in stressful situations, right? And that makes sense. So situations that we have not been in before, how are we going to know how we're going to react? So that's why we don't really like risk tolerance. We like focusing on goals, focusing on the risk capacity, the amount of risk you need to achieve your goals. Because once again, that's the whole reason that we're investing in the first place. All right, so let's give a little bit of an overview of why we want to define a goal. So the next question, of course, is how do we define a goal? What do we mean by defining goal? Well, you need to make your goal specific. Right? So when we are defining a goal, we cannot just have this nebulous, I'd like to own a boat someday. I'd like to own a house someday. I'd like to retire in, pick the dream location. You need to actually define how much your goal is going to cost. You need to define when you want to achieve your goal. You need to look at how much you've actually saved for your goal. And then you have to think about how much you can save for in the future. And there's a reason for this. And the reason is that we're going to use this as inputs into calculating the required rate of return, which we'll get to. And we've got this little thing at the bottom of the slide. A lot of people are very hesitant to define goals because they're not exactly sure what that goal is going to be, all the different specifics that I've listed out there, but ballpark it. Your goals can change over time. They will change over time, but setting up a goal then allows you to have structure every year, every 6 months, whenever you want to recheck your goal, allows you to have structure to go through the process. And we're actually going to release a podcast on Sunday where we talk a little bit about this. And Shani will talk about how Shani's changing her goals a little bit. But we need to be very specific. And just remember, these are not set in stone. They can change. So what we're looking for is your best guess on each one of these. All right. So let's use an example. And examples are always great. So let's take a retirement goal. All right. So I want to retire. And we have a whole webinar next Tuesday on how to estimate retirement amount. So how do you get to this $1.7 million? So I'm not going to spend time on that today. There are some nuances with retirement that you need to think about, but we will cover that next week. Let's just look at and focus on the goal right now. So I want 1.7 million in today's dollars. I want this in 20 years. I've got 450K in my super balance, and I'm saving 10% of my $100,000 salary, right? So we're going through that process, going through the process of defining all of those different points that we need to have a goal. All right, so the first thing we need to do is we need to take inflation into account. So inflation, of course, has been in the news a lot lately. After a very long period of low inflation, we're starting to see higher inflation, particularly in the US, has not reached the same level in Australia yet. There's been a lot of talk about if inflation is transitory, temporary, or not. But either way, you need to take inflation into account. So if we go back and we look in Australia, we measure inflation by something called the Consumer Price Index. So very simply, they take a quote unquote basket of goods, and that basket of goods is used, and they take periodic measurements of how much that costs. So that's the Consumer Price Index. So 4.87% a year between 1951 and 2021. Now, inflation has been low lately, so a lot of those larger numbers that dragged up that average happened back in the 70s. But we're starting to see inflation go up again. But remember, that's a lot, right? 4.87% is a lot. 1951, 23.9% in a quarter, which is pretty incredible. All right. So what do we at Morningstar use for inflation? So when we look out over the next 5 years, we're thinking it's going to be about 2.6% a year. But either way, just think about a number you want to include for inflation, because we want to inflate that amount that today's dollars would buy into what it would buy in the future, because we're going to see a reduction in purchasing power. One thing that's important to think about with inflation, particularly around retirement, and we'll talk about this, or another goal, if you're saving for something specific like a house, think about what CPI actually means. So you can go see the breakdown of CPI. So they have created this hypothetical basket of goods that is supposed to represent the average consumer. Well, you're not the average consumer. Nobody's the average consumer. So go look at what makes up CPI. So you can see different weights here. Housing, a little over 22%. Food, a little less than 17%. You can obviously read all of this stuff. But the reason you want to do that is because your inflation rate may be very different. So think about what you're trying to buy, what you're trying to support, and think about how inflation is going to match that. Okay, we've got a couple questions. So we've got, is that 4.8% per annum? Yes, sorry, it's per annum. Should have been very specific. So 4.87% a year from 1951 to 2021. That 2.6% is in Australia. So a couple questions so far. All right. So let's move on. So what you do with that inflation number, of course, is you want to inflate any of the numbers that you're trying to calculate. Now, as part of our goal calculation tool, you have the ability just to put in a per annum amount of inflation that you want to assume. And once again, ballpark. It doesn't have to be perfect. We're not trying to create a perfect prediction of the future, because that's impossible. But we just want to make sure that we are taking inflation into account. Okay. So what are we going to do? We're going to calculate, and the reason that we want all of these specifics around a goal, which hopefully will make sense in a little bit, is because we want to calculate something called the required rate of return. What the required rate of return is that is how much, of course, you need to earn to get from where you are to where you want to be. Right? So how do you accomplish your goal? There's all sorts of different things you need to do. You need to save a certain amount of money. You need to wait a certain amount of time, but you also need to earn a return. That's why we all invest. That's why we're not keeping all our money in cash, because most people can't meet their goal just keeping money in cash. That's why we invest. Now that return is very important. And the return, and we'll spend some more time talking about this on a future webinar, but that return is going to dictate and represent how much risk you need to take. Because as investors, we exchange risk for return. We exchange volatility for returns. So assets that bounce around in price more, that have more volatility, like a share, have higher expected future returns. Doesn't mean it's going to be every year, but it means over the long term. Whereas cash, if I keep cash in a bank, I have no volatility, right? That value is not going to bounce around. My bank account is my bank account, and I get rewarded, quote unquote, rewarded for no volatility with very little return. And we all know that by going and looking at what we're getting in bank accounts right now, or term deposits, or anything cash related, or bonds even. Bonds bounce around in price less than shares. The expected returns are lower. So when we calculate this required rate of return, then all of a sudden we start thinking about that risk capacity. So not how much I'll tolerate my portfolio bouncing around, but how much I need in return to achieve my goal. It's just a better way of framing your thinking about a return. So what we've done here is I've gone in and put this into this calculator. This $1.7 million, when I go through and put in that inflation rate, 20 years, I actually need $2.8 million. So inflation adds up over time. All right, so this is what I referenced. So this is a tool that's on Morningstar Premium, where basically you go through and do everything that I said you just did, right? So you've got $450,000. In the future, you need $1.7 million, right? That's how much I want my retirement. I am doing this in 20 years. I'm putting in a 2.6% inflation rate, and I'm saving 10% of my $100,000 salary. So $10,000. And what does this pop out? 8.6%. Now, if you don't have Morningstar Premium, you can also use a financial calculator for this. So you can look up a financial calculator just on the internet and go use that. What I will say is financial calculators, we've obviously designed this thing just in the terminology that we've used. Financial calculators can be a little bit confusing. Sometimes you do have to put in certain figures as negative, but go on there, read the instructions. So if you just go to like calculator.net or something like that, go find one of those financial calculators and go look for, you were trying to, what they'll describe as the interest rate. It's really the return in this scenario. That's what you're calculating for. All right, so I put all this in and it comes out this required rate of return, 8.6%. So what does that mean? It means all things being equal, given all these assumptions, I need 8.6% a year in order to achieve my goal. So it is a good thing that I know this because it's going to have a lot of different inputs into everything else that I'm doing. The first thing that it has is it allows you to assess the feasibility of your goal. So if that return, depending upon what that calculation is, if it is really high, you probably are not going to achieve your goal, at least given the present circumstances. So a couple things to think about, and we'll get into what too high is in a second. Number one, this return that will be calculated is a return that is taking into account fees and taxes. So everything that you will be quoted generally by the financial services industry will not include any taxes, of course, and they don't know what your taxes are. They should include fees. If we're looking at historic returns, it should include fees, but just check. So there are famously, Wilson Asset Management does not include fees. So just make sure fees are included. They generally are, and it's sort of the acceptable and frankly ethical way to look at past returns. But remember, you do have to pay. It's all fees. So it's fees if you have a self-managed super fund, if you're paying a admin fee for it, platform fees, all sorts of fees. So make sure it's all fees, including any trading costs that you have, and think about taxes. The other thing we want to look at, once again with inflation, is you will generally get nominal rates of return. So that's what's quoted. So a nominal rate of return does not have any adjustments for inflation, right? Whereas a real rate of return will remove inflation. So just make sure you're not double counting there with inflation. If you're including inflation, make sure you're using nominal rates of return. That's generally what you're going to get everywhere, but just a check. So we need to take those into account as well. So when you're looking at that return that you need to get to your goal, remember that you need to take into account taxes, fees. If you don't, then potentially your return could be something that you can't actually achieve. All right, so what is actually achievable? So listen, it's certainly an interesting question. There's a couple different ways that you can look at what is achievable. So one thing that you can look at is you can look at historic returns. Now, anytime we look at historic returns, we want to look at a longer time period. Do not look at short-term periods, especially given what's happened right now. So the market has obviously done very well since the GFC. So we want to make sure that we are using long-term returns. The longer, the better. And even though you may not be able to find that return on a specific investment you're interested in, we can go back and look at long-term market returns. So what do we have here? We've got a little chart. We've got some different asset classes. So US shares, Aussie shares, you guys can read. So we've got different asset classes. And I went back and I looked at 30 years. And I looked at the average nominal return. So that is a return, not looking at inflation, not looking at fees, not looking at taxes. Taxes are very personal, so it's hard to do that. But even if we take this average, the average super fund investment and admin fee is 1.1%, right? That's a lot. Even if I knock down these nominal returns by 1.1%, I didn't do it for cash because generally a fee doesn't apply to cash if you just put it in the bank. But if I just knock these down, all of a sudden, the returns are getting a lot lower. And then, of course, we look at real. So what I've done with real is I've removed inflation as well. And then I've done real without fees. So what I would say is 7 to 8% of nominal returns after taxes and fees. If you're much higher than that, it may not be achievable. And one of the things that's always talked about is everyone always talks about the stock market returns 10% a year. So it's sort of this often quoted amount that people get in their heads. And a lot of people that have been not investing for very long think that it actually returns a lot higher. So 10% is about right if we go back to 1900 and look at the last 120 years. But that does not count fees. So remember, fees are going to knock that down. The other thing to remember is over the past 30 years, we've had really, really high returns. And there's been a couple things that have happened. And we'll spend more time talking about this tonight and later. But one of the things that's happened is obviously we've had an interest rate environment that's been very favorable to shares and bonds. So all portfolio returns, because interest rates have come down over the past 30 years. The other thing, and what that has done is that has pushed up valuation levels. So just remember that this has been very favorable return environment. And listen, there's nothing wrong with being conservative. If you sit there and thinking a achievable return is 7 to 8%, and the market does return 10% after fees and taxes, then you just have more money. It's not the worst thing in the world. It's better than the alternative, right? Looking for a number that's too big that you're not able to achieve, and then you have to make adjustments later. So, all right. So what do you do if your return isn't feasible? Well, one of the great things about sitting down and going through this exercise, once again, even if you're going to change your goal in the future, is that you can make adjustments. So in this case, we're going to make an adjustment. Remember, we calculated 8.6%. So 8.6%, let's say we want to lower it to 7.5%. So we've got a couple different options. And the reason we've gone through and defined all the different things that I said we needed to define for a goal is because basically those are all the drivers of how much money you have in the future, right? So one of them is how many years until you want to achieve your goal. So how can I get my return down by 1.1%, my required rate of return? I can delay retirement by 4 years. So they're just mathematically, right? We're just solving for 7.5% to be the return. That's why you can have fun by spending some time with your financial calculator. The other thing you do is you can save more money. Of course, if I save more money, I'll have more money in the future. And that means I can have a lower required rate of return. So you can increase your savings to $21,000 a year. That's obviously a lot, right? It's more than double. The other thing I can do, of course, is I can reduce my goal. So maybe I don't need $2.84 million in future money. In retirement, I can reduce my goal. How much? $501,000. So those are the adjustments you can make. And that's how we can find out what is actually feasible as a goal. All right, we've got a couple questions. Okay, so some good questions. Number one, so Craig is asking, do nominal returns for Aussie shares include franking credits? No, they do not. So franking credits do add to Aussie returns. So franking credits, in a way, right? It's a tax. In this case, it's a tax break. So franking credits would be added to Aussie returns. So I believe if we go back and, well, we've got it in a report, so I won't come up with a number, but yeah, you're going to get a percentage or two from franking credits. Now, franking credits obviously do not apply for everyone. It is kind of a personal thing. It doesn't apply for every investment that you make, but yeah, franking credits will add to those returns. All right, so we've got a question from Genevieve. Okay, so Genevieve is asking, wondering if you have any opinions on online trading platforms, particularly South Wealth. I've been using ComSec since 2007, but looking at cheaper alternatives which have decent functionality, allow immediate trading. Okay, yeah, listen, I will say this. So if you do, like, I can't come up with an opinion about any particular trading platform, Genevieve, but what I will say is trading costs have come down a lot. So you're starting to see a lot of kind of fintech firms coming out on the market that have reduced trading costs. So you want trading costs as low as possible. Now, in terms of functionality, so you're talking, there are obviously different bits of functionality on every single one of these trading platforms. A lot of them are very sort of trader specific. And since I don't trade, I invest, I don't really care about a lot of them. So yeah, I just get your fee as low as possible on trading. Okay, so Lisa of Alpaca fame is asking, does the required rate of return include increases on share price value as well as dividend? Yes. So what that would be is that would be everything. So income and actual just price appreciation. So it's what your portfolio, it's everything, right? So everything you get from your portfolio, including income that's generated, minus all the stuff you'd have to pay, like taxes and fees and everything else. Yeah, so Lisa, we would include anything. All right, so now I've got a couple more questions, which I'll get to in a second. But yeah, so basically this is your opportunity to assess whether your goal is feasible. And it also allows you to go through and think about these different inputs. And they're really important because as you start playing around with these calculators, it does let you realize what are the different levers that I can pull to impact my future. And obviously, the earlier you do this, the better, because it allows you to make more adjustments. The biggest thing, obviously, and the thing that you can never get back is time. That's why you want to do this early. If you do this early, you have to save less money to get the same outcome. So you don't want to be playing catch up. And I think just playing around with this required rate of return calculator does make you very aware of what the different things you can do. So I think it's a good exercise in general. Oh, we have a quiz. So the quiz I'll send out. So that'll come out in the email. But I have added a quiz to this. All right, we've got some questions. Let's see, what do we got here? Obviously send things. All right, so a couple of good questions. So Richard is asking, does your calculator also allow you to calculate the rate of return required to generate a required investment income from a starting lump sum in retirement? All right, so this is a little preview for you, Richard, of what we're going to cover next Tuesday. So the way that one of the reasons why retirement, just thinking about requirement too much. One of the reasons that retirement is a tricky concept is because we need to translate a lump sum into an annual withdrawal. So that's why it's very difficult for people to think about retirement. So basically the way that you go about, and once again, this is a very quick preview, the way that we want to start thinking about retirement is we want to start thinking about what can we safely withdraw from our portfolio and not run out of money before we die. Now, the problem with that, of course, is you don't know when you're going to die. And so there's been a lot of talk around what is a safe withdrawal rate. So the famous safe withdrawal rate is the 4% rule. So this guy, Bill Bengen, a financial planner in the US, came up with this 4% rule, saying that you can withdraw 4% from your portfolio every year. It will last for 30 years in any historical market combination. So basically he did this in the early 90s. So I think he looked at 1992 to 1926. I think that was a time period, 1926 to 1992. That was a time period he looked at. He looked at any combination of market returns, and that is where he came up with that 4% rule. Now, we recently came out with a report at Morningstar saying, given sort of valuation levels right now, we think it should probably be lower, but we'll cover that next week. But that withdrawal rate is how you calculate that lump sum. So in the case that you wrote, Richard, where you say, looking at investment income from a starting lump sum in retirement. So you would just apply that withdrawal rate to it. So 4%, you have $100,000, obviously $4,000 a year. That would increase by inflation going forward. If you are trying to figure out what that lump sum is, you would think about how much money I need. And we'll talk about how you estimate that as well next week. But that's a good question. All right, returns on residential property. Yes, I don't have the number in front of me. But yeah, I mean, we can go back and look at returns on residential property as well. If we look at historic returns, once again, go back a long time period. So obviously property has done very, very well lately. But once again, I would encourage you to go back, but that stuff's available. Like if you Google it or send me an email and I can send it to you. We've got that. Okay, really good question by George. Standard deviations. Okay, so what George is talking about, so he says, can publish your standard deviation on those returns. So, okay, a couple of things. So George, we were looking at historic returns there. Now, Morningstar has projected future returns as well. And we're going to cover those in a couple of weeks. I know I keep saying that, but what is George asking around standard deviation? So standard deviation is a statistical measure of volatility. So basically what we're looking for in standard deviation is we are looking at the average return and then what are the differences between the returns each year and that average return, right? So that shows you volatility. So remember, like average is average, right? Market go up 10% one year, down 10% the next year. Your average is zero. But standard deviation is looking at what is that deviation between the average and each return we get in the period we're calculating the average. So standard deviation allows you, once again, is a historic look at volatility. But what it allows you to do is look at percentages. So basically, if you look at one standard deviation, I think it's 68% chance that a return is within one standard deviation. So standard deviation is 10. And the average return was 0, there's 68% chance a return would be between plus 10 and minus 10. If this is a little confusing for you, don't worry about it. 2 standard deviations is 95%, so 95% chance within 20% of each one of those, because standard deviation is 10. So it's just a way that we measure volatility. Now, what I would argue is that over a long time period, we shouldn't care about volatility as investors. Now, it can become very important as you're approaching your goal. So as you're approaching retirement, if there's a lot of volatility, because down markets have really, really poor outcomes on retirement, right as you're entering retirement and for the next like 10 years of retirement. You don't want the market to go down too much. So that's when something like standard deviation would matter. But you can see that it will be it's a data point that we have on Morningstar. So you want a lower standard deviation and a higher return, right? So that's the risk and return trade-off you're making. Generally, as you get a higher return, you have a higher standard deviation. So yeah, we will go through that. And George, if you want to email me, mark.lamonica1@morningstar.com, I can send you our projected future returns and the standard deviations that we expect into the future. Okay, we have the franking credit. All right, so let's see what else before we get into the tricky questions. Okay, yeah, so Mabel has a really good question. If you're saving for retirement, is it better to make use of super rather than investing outside of super, maxing out contributions and using the leftover for investing outside of super? Yeah, listen, with super, okay, a couple of things. Obviously, everybody's situation is different, but what is really, really important? What's really important is obviously minimizing your taxes. And one of the very good ways of minimizing your taxes, of course, is to use super. So for most people, saving within super is better. It's a great deal from a tax standpoint. So if we think about what we're trying to do, of course, get after tax returns, then you're generally going to pay less tax with super. Obviously, everybody's situation is different. That's the little caveat. But the one thing I would say about super is obviously you need to make a determination on in terms of the flexibility that you want with your money. So with that tax savings, there are, of course, a bunch of rules that you need to follow. And one of the rules, of course, dictating when you can retire, how much you take out of your account, and then at some point, how much you have to take out of your account. There's all sorts of rules associated with super. If we're looking from a purely investment standpoint, super is generally going to be better for you from a tax perspective. But if you want to retire early, for example, and want access to funds, then maybe you would make a different decision. But that is obviously very, very specific to everybody. Okay, the anonymous attendee, our favorite attendee, said, are we able to receive a copy of the video for people who missed the start of today's session? Yes. So one of the things I said at the start of the today's session is we will send out an email that has a link to the video replay and the materials and everything else, so you can take our little quiz. All right, so we've got a comment. Lisa said, it's, in my experience, it's good to have a balance between super fund wealth and personal wealth. Yeah, so that's obviously specific to Lisa. I will say that I believe the same thing. So, I spent a lot of my younger days getting as much money. I did not live in Australia at the time. So it was US retirement accounts, trying to get as much money and maxing out all my contributions into retirement accounts, so tax sheltered retirement accounts. And I backed away from that as I've gotten older, because now, to me, the flexibility of not having money, I still obviously make super contributions, but not having money in a restricted environment, I think is beneficial for, sort of my immediate future. So. All right, so now we've got all the tricky questions. So, so we've got questions on. All right, so we've got. Can you speak briefly on rare earths and lithium? So, thank you for that, Vince. Not credibly, listen, lithium is obviously very popular. All the sort of all the materials that go into batteries are a very popular thing to invest in right now. Listen, I think the thesis makes a lot of sense. I would just be wary of it depends upon the investment. I would be a little wary of the space where there's so much investor interest that you are actually investing in something that that is going to work out. It's not some speculative miner that doesn't actually ever make any money. All right, so we've got a question: return on alternative assets like gold. All right, so gold's an interesting one. So gold has famously been used as, I guess more of a safety mechanism than anything else. In times of economic or political stress, gold tends to go up. The interesting thing about gold is, so if you go back a really, really long time with gold, and it was this interesting study where they went back and they looked at Roman soldiers who were paid in gold. And then they looked at like U.S. military and translating the different salaries that you make, obviously based on rank and everything else, and translating that into gold. And the point, and this is more of an academic study, is that gold basically had no real increase in value in thousands of years. That gold went up by inflation, but there was no real excess return over inflation. So yeah, gold's an interesting one. A lot of people are talking about Bitcoin now and how Bitcoin will perform in different environments. And of course, the answer is we don't really know, because Bitcoin hasn't been around very long and we have not had different environments. We've sort of had this very accommodative central bank environment since the GFC on, which is kind of the life cycle of Bitcoin. So I think in that case, we don't know, right? We can't go back 30 years with Bitcoin. So yeah, I don't have those returns in front of me. I do have them. So if you email me, I can give you sort of, I have a return on sort of a mixture of metals. So it's like gold, platinum, silver, something like that. And how it's performed in different environments. So if you want that, send me an email. All right, well, look at this. We're out of questions, which is a good thing, I think, for me and all of you. So anyway, out of questions. If you have any questions you want to send me, send them to mark.lamonica1. So Mark, so I'll try to put this in the chat if I can, everyone. There we go. I'll put this in. So it's just mark.lamonica1 at morningstar.com. So it is the email address that's in the invite and the confirmation that you should have received. So you can get the email address there. So if you have any questions, send them along. For anyone who's going to be on tonight, I'm doing one of these at 6 o'clock Sydney time, kind of looking at a market outlook for next year. And anyone who's interested in continuing this course, of course, we'll be back same time next Tuesday, and we'll talk a little bit about retirement, which hopefully should be interesting. You guys can all comment on how I need to retire. All right. Well, great. Well, thank you guys.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.